Bond markets reverse sharply after poor macro data shows that we may already be in recession. Stocks take comfort from a Fed pivot that's priced for Q1 next year. And the dollar takes a breather as the ECB gets serious. All this and more in this week's Macro Insight. Okay, welcome to Macro Insight, everyone. Today is the 26th of July, and let's take a look at these markets. So what was going on last week? If we bring up our vol-adjusted moves, we can see that last week we had stocks and bonds rallying. So stocks and bonds rallying. Asia ex-China was actually leading the way on a vol-adjusted basis. So you can see Nifty up here, 1.5 sigma. You can also see Nikkei was up similar. Then after that, you had Europe, where you've got the Euro stocks and DAX up here. Kind of a relief rally really there in Europe after the Nordstream pipeline came back on, when it was feared that it might not, even though it came back on with reduced volumes. But the market kind of took that at least with a bit of a relief, a sigh of relief. And then the S&P was also up about 1 standard deviation on the week. Industrial commodities, rallying too, the likes of natural gas, both in the US and in Europe. Palladium had a good bounce as well. Metals had a bit of a bounce, but silver and Aggs were the underperformers in the commodity space. The weaker macro data saw bonds well bid, with the US 10-year testing recent lows around 270 and the 210s reaching as far as around 25 basis point inversion, which is kind of the lows we've seen in the cycle so far. Crypto markets were obviously firm as Ethereum continued to trade well on recent merge speculation. Okay, now if we drill down into what we're seeing on the macro data front. So we've got obviously the incoming macro data continues to point to recession. Eurozone PMIs dropping below 50, you can see here. So not looking great, but market was has been talking about this for a while, so not a massive surprise. But what you did see was a dramatic kind of bond market reaction in Europe, right? And we'll talk a bit more about that later on in the call. Okay, US Philly Fed also missed expectations. US services PMI also printed contractionary at 47, whereas expectations were more like around 52. Okay, so far housing and employment seem to be holding up better. Okay, so we're seeing the PMIs roll over. We're seeing inventories versus new orders, leading indicators like that all rolling over. But on the employment side, we're starting to see the rate of change obviously go the wrong way, but that's not quite rolled over. So you see a small little uptick there in jobless claims. You see the number of employees in the Philly Fed survey not collapsing like new orders, but it's obviously slowing down. And then if we look at housing markets or house prices, US house prices are still kind of sitting up there near the highs, whereas leading indicators of housing, like housing starts, lumber prices, things like that, and obviously we know what's happened to mortgage rates and affordability, all those things suggest that it's only a matter of months until we start to see those other housing and employment data points kind of join the party, basically, right? So join the weaker trend that we're seeing. Okay, so if we then look past the macro to the micro, obviously we're in the thick of earnings season. So how has earnings season been so far? So all these sort of data points and analysis are from Mr. Blonde Macro on Twitter. Does some really good stuff. He's got a newsletter called Stuck in the Middle. I suggest you subscribe to it. It's pretty good. So what's he saying here? So looking back at a bunch of quarters going back to 2010. So what do we typically see in earnings season? We typically see some positive performance in the couple of weeks prior. Then the first week of earnings season tends to be positive in terms of performance, and then it starts to taper off as we go through second, third, fourth week of earnings. Okay, so that's one thing to be aware of. Obviously, we had a decent week last week. in the first couple of weeks of earnings so far have done okay. If we look at how, what we've actually seen on a sector basis, well, EPS growth, we see the big negatives in comm services, consumer discretionary, financials, pretty big negatives there. But then if we look at the relative stock prices and kind of how they performed, they haven't been cratered basically, right? So it's showing you that the market was kind of expecting these negative kind of growth numbers in terms of earnings, and the reactions so far haven't been that dire, right? Even when they've lowered guidance, okay? Now, taking that one step further, if the surprise has been particularly large, right? And that's this table on the bottom left, right? If we've had a, big surprise to the upside, 3 to 6 sigma surprise, or we've had a negative 2 to 3 sigma, this is what sort of performance we've seen, the 3-day relative return, if we've had big surprises in EPS, right? So you can see on the big misses, we've had pretty bad stock price reactions. And then on the big beats, we've had much more muted rallies, basically. Yeah. So it's showing on average, as long as it's not a massive hit or miss, the market's digesting it well. But on the big misses, stocks are getting punished, right? So obviously we had the likes of Snap, right, which was down 25%, whatever it was. We had overnight, we've had Walmart profit warn as well, right? I think that stock was indicating down 10%. So obviously on the big misses, they are getting punished, and that's generally quite bearish, right? When you see the misses getting more punished disproportionately than the beats, basically. Okay, but in general, so far, the earnings, have kind of come in line with expectations, and we haven't seen this massive re-rating that we are thinking we might get on weaker earnings. Okay, now let's bear in mind that these numbers could all look quite different at the end of this week, because we've got 50% of the S&P reporting this week. Yeah, so I'm sure we'll have some more data, in the coming weeks to see how it all played out. But that's kind of how things have started off in earnings. Okay. In terms of what else is kind of giving the bid to the market, right? Obviously, we've mentioned it a few times in recent weeks. Is one of the big drivers as to why the market can't sell off is because there's positioning that's very light. So Charlie McGilligut's a good guy to follow at Nomura. He's like their macro strategist. He basically says that, from what they see, macro funds, long, short, mutual funds, all their betas are pretty damn low, right? So that's these charts on the left-hand side, okay? So they've got pretty low exposure to the market right now. And then we know that the vol target funds are basically reacting to the rollover in realized volatility and have to add exposure back to the market, right? So we've had the 1 month realized over the course of the last month has gone from like 30s down to 20. And then the 3 month, which is in red, that is likely to start rolling over, because if we look in this table in the middle here, the 3 month dates, the big moves in the next week, in the next 10 days, there's about 6 big lumpy moves that are rolling off, right? So 2.8%, 2.8, 2.5, 3.6, etc. When those large realized moves drop out of the 3 month realized sample, that does have impact, and that will start to see that 3 month realized rollover. And then various vol target funds that will be using 3 month realized as opposed to 1 month will then be forced to buy more delta to the market. And the type of numbers we're talking about, if we add back corporate buybacks, which are also coming out of their blackout period, right, at the end of this week, that's going to go back to what it was. The Goldman's guys who've tracked this stuff quite closely are saying between $5 and $10 billion of delta to be bought every single day, right? So that can obviously cushion quite a lot of bearishness on the fundamentals when that systematic buying is happening under the hood anyway, basically. Okay. Was from Alf, obviously always does a good job on the macro compass. That's a free resource for you guys, but I like to summarize it every week, or when I think it's worth it. So what's Alf seeing? So here he's trying to figure out whether this is a bear market rally or something's really changed. Does he need to change his sort of bearish thesis? Because he's been quite bearish as well for the last sort of quarter or two. So he looks at real yields versus equity valuations. And he's saying, this latest bounce in the market is quite consistent with what's going on in 30-year real yields. They had kind of popped up to 60 odd basis points. They've pulled back about 10 to 15 basis points. But given what the Fed has said about real yields and what they've said about neutral rates, it's unlikely that they're going to really want to see real yields come back down that much in the short term, right? So that's not going to be supportive for equities if real yields continue to stay here or go higher. Okay. Also looking at the dollar, this is over a long-term horizon that the dollar's kind of higher. Obviously, it's not at the highs on this chart, but basically saying that a stronger dollar, which is likely to persist, is going to be a drag on corporate earnings. You've also got the large divergence between the Fed funds dot plot, so what the Fed have said rates are going to be versus what the market is pricing. So the market has already priced in quite a dovish pivot for the FOMC into next year, okay? And so at the margin, that's going to, the Fed is now going to have to either confirm or deny that, basically, right? So, where do we think that's going to go, given that we haven't seen inflation numbers really rolling over? We've seen lead indicators to inflation rolling over. We've seen inflation expectations. We've seen break-evens come down. But in terms of the actual hard prints, there's still some strong momentum in inflation, right? So is Powell going to soften his language so much? Remains to be seen. And if we see more hawkish kind of response to this pricing in the press conference, then arguably that's going to potentially be quite bearish for stocks, right? Given that they're already priced in quite a lot of dovishness into the bond market, okay? And then the last thing Alf analyzed was he looked back at previous recessions, and he's basically saying that on average, so if we go into a recession with elevated inflation, on average, it takes 16 odd months to get inflation back below target of 2%, okay? So that's quite a long time, right? And then peak to trough, you typically see CPI drop by about 6.8%. So basically saying, yes, if we are heading into a recession, looking back at previous recessions, they do make inflation come down by a significant amount, basically, right? So that was his analysis. Now, the analysis that I mentioned that Darius did over the weekend, which I thought was great, again, looking back at past bear markets, past recessions, to try and get some context of where we are. And what he found was that whilst the market typically bottoms a good few months before the growth cycle bottoms, right? So before we see a bottom in the growth data, that the market would have bottomed ahead of that, okay, right? But it doesn't bottom before the inflection in the liquidity cycle, okay? It typically bottoms about a month after that. So an inflection in the liquidity cycle basically means the Fed pivot that we're all talking about, whether they pause their rate hiking, whether they go to cutting, whatever it is, whatever they do with QT, if they stop that at some point, that is an inflection in the liquidity cycle, okay? And typically markets bottom after you see that, not before. So right now we've got the bond market pricing in that the pivot's coming early next year. So people are saying, oh, well, if we know the pivot's coming, then the market can bottom already. That would be unusual compared to what we've seen in the past, right? Typically you need to actually see them actually pivot and actually change their policy for the markets to bottom, right? And that was the conclusion from Darius's stuff at the weekend, which was amazing. So if you are a 42 macro subscriber, it's about 50 minutes this time around. Is about double the length of the normal one, but it's definitely worth a watch, right? Because he really, the depth of his analysis is so rich that it's always, and it's good to help you get more conviction around your own views, right? If you kind of agree with where he's coming from, and that's what I appreciate about people like Alf and Darius, right? They have their analysis, they have their views, but they're always questioning, right? And they're always trying to evaluate, are we missing something, right? Like what could go wrong here? And I think that's what makes me respect them more than, the average analyst out there. Yeah. So this is what I've put together on the VIX, right? So we obviously know the VIX has been kind of chopping in this kind of triangle, right? Where the highs have been getting lower and lower, but actually the lows have also been grinding a little bit higher. So it looks like kind of bottom of this channel or this triangle, if you want to call it, on the VIX comes in somewhere in the 20 to 21 area, basically, right? Somewhere around here, okay? Now, I suspect that is where we're headed post FOMC, right? Because usually there's a bit of air to get taken out of the vol market post something like a big FOMC event. Okay. And last week, we did see, the VIX touch that 22 handle in terms of VIX spot. August futures are still trading at around 25 on VIX. And they're, like I said, they're likely going to hold up until FOMC, and then they might get their next sort of leg down after that, if they're going to. Yeah. Realized volatility. People are looking at 25 VIX thinking it's low, but the reality is realized 5 days 13% on S&P, 10 days 20%. And if the markets can rally above 4,000, and we can see spot gamma here, just how much kind of, relative to the other strikes, just how much sort of stickiness there might be around that 4,000 area, then, you could see a bit of an epic vol crush going into a quiet August. August is often a bit quiet, right? Given that people are on holiday and stuff. So there is that risk if the market can pop its head above 4,000 that vols have got another leg down. So how would I play that, right? If that was the view, if your view was that we're going to get FOMC, they're going to deliver the 75 bips, there's enough kind of systematic buying to hold this market in there. And, the market, whilst it might be going lower medium term, it's got another month of nothing left in it, right? Nothing, a sort of low realized type month. Then how could you play that? Well, if we look at what the VVIX is doing and what the VIX, well, we said the VIX might have some downside, but we know the VVIX has been battered. Okay. So what I've got here is I've got the 1 month VIX 90% put implied volatility. Okay. So that's not quite the same as the VVIX because I'm looking at a 1 month option on the VIX struck at a lower level of the VIX. Okay. So if the VIX at 25, then a 90% put would be 22.5 strike. Okay. And 1 month maturity. So you can see that the implied vol on this put, typically going back, a year it oscillates around 100, right? Typically. Okay. Lows of 80, highs of 140. Right now it's at 66. Okay. That is as low as it's been in God knows how long. Okay. So to buy puts on the VIX is as cheap as it's been in ages. Okay. And that's for whatever reason, because of the way the skew is flattened, because of the fact that people maybe have sold a load of puts because they don't mind underwriting the VIX. But the truth is, if we go into a quiet month, there's no reason why the VIX can't drop another 3-4 vol points, in my opinion, right? I think 24 down to 20 is very possible, okay? And it seems from the pricing of these puts, they are just too damn cheap, right? And if you don't want to spend money on that because you don't necessarily have a high conviction that VIX is going to go down to 20, what you could do is look at S&P calls as a way of funding that trade, right? So if we then look at 1 month S&P 105 calls, same thing, you look at the implied volatility of rolling 1 month S&P 105 calls, that's sitting at about 18.5, whereas, it used to live at 10 vols basically. So it's telling you that S&P upside is relatively expensive and VIX downside is relatively cheap. So the good thing is you could pair those trades against each other, right? And if the market rallies hard, the trade will probably be a bit of a scratch because your VIX puts will go up in value and multiply in value because the VIX will go down. And the calls that you're short will multiply in value because the market's going up. And net, those two options will kind of behave in line with each other, right? In the scenario that market just rolls over and melts down, you didn't spend any premium and both the options go out of the money, right? Because you did one option against the other, right? The scenario where the market maybe grinds up over the next 2-3 weeks and vol gets battered, right? That's the scenario where you clean up on this trade. Because you spent no premium, your calls that you're short don't become intrinsic, right? Because the market doesn't rally enough. And vol just gets nailed by about 3 to 4 vols, which in percentage terms is 15 to 20%, right, in vol. So those puts might cost you 35 cents, something like the August 22s, 23s, whatever strike it is. They might triple or quadruple in value, basically, in that type of VIX move, right? So for me, that is setting up as quite a nice relative value trade to play a potential shank in the VIX post FOMC. So the time to get that trade on is before FOMC because that is your catalyst for vol to start to come down, basically. All right, that's the kind of actionable trade idea in vol space that kind of came to me. Yeah. The dollar obviously has been flying. It was kind of due a pullback, and that seems to be what it's having. For the dollar bulls, clearly nothing to be alarmed about, right? I mean, very strong uptrend in place since kind of February after it broke out above that 97 level in DXY. It's been charging higher. It's kind of pulled back into the middle of that channel, and it's already started to bounce a bit, basically. Euro coming under a bit of pressure today, right? Now, in terms of, what we're looking at in the dollar, obviously we've got the major FOMC catalysts. We've got markets having priced in a dovish pivot in advance of any real sort of slowing in inflation data. So the risk remains probably to the hawkish side, in my opinion. This could provide some dollar strength, right, this week. Euro obviously bounced from oversold conditions near parity as the ECB hiked 50 basis points, which was a surprise, but they kind of leaked it as well, that they might do it. Italy's government collapsed and Bund BTPs have touched sort of 240, 250 again, right? So, this credibility of the new policy tool remains to be seen in terms of the ECB's anti-fragmentation measures and what they're going to do in the peripheral spreads. Okay, so Bund BTPs are still up there, so they're still kind of challenging the ECB, let's say. Okay, in terms of volatility in FX land, it's obviously inflated ahead of the FOMC. So you would expect to see a decent reset in the front end, at least, given, because there's quite positive carry right now in FX, right? You've got implied sitting up like at 11-ish, 11, 12, and you've got realized down at like 8, 9, right? Which is quite a chunky spread in FX land. Typically that differential doesn't tend to be that much. It's just because the market has been moving a bit and then suddenly we've got the FOMC, so everyone's scared to sell in gamma. But if you kind of believe now that the euro has established a bit of a short-term trading range in the parity to 105 level, let's say, right? Because these things aren't necessarily just going to fall through the floor instantaneously, right? But if you think parity to 105 is a short-term range in euro, then I don't think selling that strangle ahead of FOMC is that bad a trade, because the short end vols are pretty elevated in euro, and so that you get a reasonable, like I did some September ones. You can pretty much sell the 105 parity strangle to September. You can sell for about 200 basis points, right? Which I think it was 200 basis points, which is quite good value, really. Like in terms of, when I say good value, it's probably going to go down in value right after the FOMC, as long as we don't smash through either side of that range. And I kind of suspect we won't, given that I'm not anticipating a major surprise out of the Fed. So chart at the top, you can see here that German yields were higher into the ECB. So we've got the 2-year and the 10-year. Got 2-year in orange, got a 10-year German rate in blue. So both marched higher into the expected hike, and the fact that the hike was bigger than expected. And then the very next day, German PMIs come out, European PMIs come out, and they completely give the whole move back. So 2-year and 10-year down by like 35 basis points in a day, which is like the largest move we've seen since Lehman's, right, in 2008. So that was pretty dramatic repricing there. If we look at the US rates market, that also came down pretty hard. The yield came down pretty hard. Now testing that 270, which looks like a bit of a neckline. This is the head and shoulders that Raoul Pal keeps going on about, banging the drum in his bullish bonds thesis. But yeah, if that 270 level breaks, then technically it's got quite a lot of room to go down, right? I just wonder whether or not the market's got a bit ahead of itself in terms of pricing in dovishness, and there may be some pushback from the Fed in the short term at least, until they just can't deny that, yes, we're in recession and we're not going to do any more. So, it's something to be aware of. If you look at other bond markets, I mean, HYG's had a good rally back up towards, almost touched that downtrend, that green line. I had said when we were at 76, I'd said it's got some room to rally before it really gets to that line. If we get a bit more risk on over the next couple of weeks, maybe it does go back to that line and gives you an opportunity to short it via puts or put spreads or something like that, which I'll be looking out for, and I'll let you know. And then the last chart is just from Jim Bianco, basically looking at the 75 basis point hike that's fully priced in for this meeting, and what the probability is for the September meeting to be 75 bips as well, and how that pricing has evolved through time. So the September meeting did get 97% probability of a 75 bip hike, but that's gone back down to 47%. Okay. So it's basically a 50-50 right now as to whether they're going to do 75 bips in September or not. That's what the market's saying. And I'm guessing Powell, that's going to be the main question that Powell's going to get asked, or kind of, what the market's going to be trying to decipher in the press conference. And whatever that pricing does is probably going to determine what risk assets do, basically, right, to an extent. So definitely keep an eye out for what that implied probability is for September on the FOMC this week. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.